All right, let's get started. So we've got a lot on the agenda for you today, but first I would like to introduce all of us. I'm AJ Ayers. I am one of the co-founders here at Brooklyn FI. I head up our financial planning team, where we help lots of folks like yourselves. I see a lot of you in here, do advanced tax planning strategies throughout the year. We are gearing up for our year-end tax planning meetings with all of our clients individually. So this webinar uses some of those basic strategies. We wanted to bring them to a wider audience. I've also got, I don't know where they are on your screen, but I've got Emily. Please introduce yourself.
Hi everyone, excited to see some familiar names on the list. My name is Emily. I am a tax manager at Brooklyn FI. So we're looking forward to 2020 tax planning right now and trying to get 2019 extensions wrapped up. So really busy on the tax end, but looking forward to moving on from the 2019 tax year and helping you guys with your 2020 planning. And I have Shane below me here. Shane is another partner. He's on the tax side, so we work together a lot.
Perfect handoff. Thanks, Emily. We have, I'm Shane. A lot of people, a lot of similar familiar faces, as AJ said, on the participant list. Some people we're going to be having these conversations with pretty soon, so they're going to have a preview of the conversations that we're going to have with them. As a reminder, this is the personal year-end planning sessions. We have a business planning session coming up. I think that's next week, or is that in 2 weeks, AJ? I don't
Next
remember.
month, yeah.
Next month.
We're doing a monthly webinar series. So this is our second of 4 webinars. The next one will be the 4th Friday of October. We've got the exact date coming up later.
Cool. That's perfect timing. So if we're going to touch on some business stuff here at the end, but we're just going to touch on it. This is mostly focused on individuals who generally need a little bit more time to do some year-end tax planning meetings. So looking forward to digging into that. I head up the accounting and the tax department at Brooklyn FI. So I am the resident tax monkey over here. And yes, Emily and I do work together routinely, coming up with year-end tax planning strategies that we're going to discuss today.
And Emily is in a different state than us, which is why her photo looks different. We have added a bunch of new team members to the team. We have not all met in person yet to be able to update our headshots. So we're looking forward to doing that in 2021, hopefully. Cool. So sorry, there was a quick preview of some fun images I added recently. Here's our agenda for today, which we are going to go slightly out of order. But basically, we're going to talk basic retirement contributions. A lot of you are doing these contributions already. I just wanted to do a recap. There's still time in the year to make changes. That's why we're doing our year-end meeting starting in September, because things like opening an account, making moves can take some time. So our year-end starts now. It's already started. We'll talk about how to handle taxes as an employee with a side hustle, some tips there, how saving for college could reduce your tax bill. That's a fun one through a 529 plan. We're going to focus a lot on charitable contributions because the rules have changed a lot for 2020 with some COVID-19 law changes. So Emily's going to walk us through all those. We'll focus on tax loss harvesting for a hot minute. That's an investment strategy that we're going to employ with all of our clients whose assets we manage. We'll touch briefly on business owners, and we have the added bonus of talking about marriage. So we get this question a lot. Should I get married or divorced for tax purposes? Generally, we don't recommend getting divorced for tax purposes. It's pretty traumatic. But if you were already going to get married anyways, you had a date set in February or March, well, why not just go to City Hall, tie the knot a little bit earlier in this tax year if it could potentially save you a bunch on taxes. So we do this calculation for our clients sometimes. How much would it save me in taxes if I marry my future spouse in this tax year? And why is that important? First of all, I want to talk about these folks here. We have Posh and Bex on the left, and the Beebs and his new wife, Haley, as well. So these are different points in time. And I bring up this very 90s looking wedding and this very 2020 looking wedding to show you how the tax law changes all the time, and the tax brackets each year change. So whether it makes sense to get married for tax reasons is just based on so many different things. So there is a marriage penalty and there is a marriage bonus. And one thing to keep in mind is that whether you're married or not is your status on December 31st of that year. So if you are single the whole year, you fall in love with someone on December 1st, and this is the person you're going to spend the rest of your life with, you get married on December 31st, you are considered married for that whole tax year. On the flip side of that, if your divorce is finalized, in April, you will be considered not married for the entire year. A lot of times folks will enter into a separation agreement without a final divorce. You will still need to file your taxes married, even if you are separated, you have an agreement. We need those final divorce paperwork, those divorce paperwork, that's what the IRS is gonna look at. So generally, when does it make sense to get married? When one spouse has higher income, has disproportionately higher income than the other. Generally, with the way the tax brackets work, if we have one high earning spouse and one spouse who's maybe just getting their business started, that is usually the case, or usually the point at which it does make sense to get married, because the way that the tax brackets are applied to your income, when you get married, you have a wider amount of income that's going to be applied to a certain rate. And I'm going to show you what that means here. So these are the tax brackets for 2020. So I want to focus here on the 32% bracket, because your 32% bracket for single individuals here starts at 163,000. So I fucked up these brackets, didn't I? I didn't show you the actual brackets. But our 32% bracket goes from 163 to 207,000. But if we look over here at our the start of the 32% bracket, we have there's a much higher income percentage that's going to be taxed at that rate. So if you make 163,000 as an individual, you're going to be, your next dollar is going to be taxed at 32%. If you make 163,000 as a married couple, you're going to only fall into 24% bracket. So there's that nice tax savings there. And that's what we talk about when this is the case where we would say, actually, it might make sense to get married this year because it's going to save you a bunch in taxes, potentially, close to 10%. Some other things, the marriage bonus. So that's the marriage bonus. The marriage penalty can happen when we have two high incomes that come together and just push more of our income into the higher brackets, into the 35 or 37% bracket. So if you're a client, we'll be talking a lot about this with you. We generally don't like to give relationship advice, but we can tell you the tax consequences of whether getting married or not makes sense. So those are our tax brackets. By the way, we're going to present for about half an hour, and then we'll open this up for questions. So if you do have questions, please type them in the chat, and I'll be monitoring them, and I'll either feed them out to the panelists or we'll address them in the Q&A at the end. So with retirement plans, a lot of you have 401ks either through your employers or you've set up your own individual or solo 401ks. The benefit of a 401k is that you are able to stash dollars that you're earning this year into a special retirement account that is not going to be taxed until you pull those dollars out in the future. Most people don't pull those dollars out until their 70s, right? Those dollars are going to be invested in the stock market for decades, hopefully, generating a lot of wealth for you, protecting that wealth from taxes and also from yourself. The reason we love 401ks is because Congress has applied a bunch of protections to them, right? You can't pull money out before age 59 or you owe a 10% penalty. That's pretty good incentive not to borrow from your future self. So that's why we love 401ks. They offer tax breaks this year. The money grows tax deferred, and it's also protected from your own worst enemy, which is yourself. So a lot of people ask, should we contribute to a traditional 401k or should I use the Roth option? We talk a lot about Roth IRAs, but often employers will also offer a Roth 401k. If you Google, one of the most frequently Googled personal finance question is, should I contribute to my traditional 401k or my Roth IRA? Generally, Brooklyn FI believes that if you're going to be paying more than 24% taxes in the current year, if you live in New York City and you're paying that additional 9 to 13%, probably makes sense to do the traditional contribution, meaning you get the tax deduction this year. Let's take the tax break, use those funds, invest them elsewhere. So a Roth 401k generally only makes sense if you're really starting out your career and you're in a very low bracket. The maximum contribution for 2020 is $19,500 per person. It's not too late to max it out. So if you have never contributed to a 401k before at your job or through your business that you own, it's only September, right? We've just got 3 more months to do that for the rest of the year. We can make changes so that you can actually get almost $20,000 into your 401k. One caveat is that it's got to come from your paycheck. You cannot just say, oh, I got to max out my 401k. I'm going to move 19K from my checking account right into that 401k. It's got to come through a percentage contributed through your paycheck. So that's why September is generally like the last point at which we could say, oh shit, we got to start contributing to our 401k. So watch out for that. Another type of account we don't want to forget about is the HSA, the health savings account, which is another vehicle where we can contribute dollars this year, get a tax deduction, have the money grow without paying taxes on it. And then if we use those funds for our health expenses, like just going to the doctor, paying a copay, having surgery, having your kids get orthodontics braces or whatever those things are called. I had those for 6 years. I was really cool in 8th grade, just so everybody knows.
I think you had it right. I think you had it right, orthodontics.
Yeah, orthodontics. I had braces through my senior year of high school. I was really cool in high school, just so everybody knows.
That explains so much.
I was not cool in high school. But now I know so much about HSAs. So HSAs are what we call triple tax free because you get that, like a 401k, you get that tax deduction. Now, this year, it grows tax free, but if you use those HSA dollars for medical expenses, you don't pay tax on that money. So that's super valuable account if you have access to that through your employer. Or if you're self-employed, you have access to that through your state's marketplace health plan. All right, we're gonna move a little bit faster here. The other option we have, if you don't have a 401k or you're not a business owner, you can make a contribution to an IRA or an individual retirement account. Almost every person who makes a wage in this country is eligible to contribute $6,000 each year to an IRA. The rules of whether it's deductible or not are a little bit complicated, but essentially if you don't have access to a 401k at work, the IRS feels bad for you and they're gonna say, well, all right, you don't have access to that, so your $6,000 contribution can be deductible. Whereas if you do have a 401k at work, IRS is not gonna be psyched about you also getting another $6,000 deduction. Doesn't mean you can't put the money in there. You can still make the contribution, you just won't get the deduction. Which is why we are big fans of the Roth IRA, meaning that you're gonna put the money in now. You're not gonna get a deduction this year already. The money is gonna grow tax-free for many years. And then when you pull it out in retirement, you are not gonna pay tax on that money. So we get tax-free growth and tax-free withdrawals in retirement, which is why we love the Roth. And down here, we've got a sentence that says, real heroes contribute $19,500 to their employer-sponsored 401k and $6,000 to their Roth IRA. There is a slight catch in that if you make too much money, roughly around $120,000 as an individual and $200,000 as a couple, the IRS does not want you to contribute to a Roth. So they have made it difficult and they have said you are not allowed to do that. But tax professionals and financial advisors have gotten together and said, hey, we found a loophole. We're gonna call this the Backdoor Roth IRA. We're gonna be able to make this Roth contribution, but we're gonna do a little bit of fancy footwork. We're going to make a contribution to a regular IRA, but we're not gonna tell the IRS that it's a Roth quite yet. And then we're gonna convert it, we're gonna make it into a Roth by the end of the year, and then it will be treated as like a Roth for in perpetuity. So we love a Backdoor Roth. If you're a Brooklyn FI client, we're probably doing this for you this year already. The super cool thing about a Backdoor Roth is that if you work for a tech company like Amazon, Asana, Google, or Palantir, you might have the opportunity to do a mega Backdoor Roth IRA. which the film The Meg is all about. The film The Meg is all about how you're able to contribute $37,000 in additional income each year to this totally tax-free account. Emily, have you seen The Meg?
I have not seen The Meg.
It's a fantastic film. It's about a megalodon prehistoric shark that's like the size of the Empire State Building. It's pretty great.
I was gonna say,
Anyway.
I didn't know it had anything to do about Roth, but
it doesn't.
And I watch it.
It doesn't. So if you work at a company that does have a 401k plan, my advice is to reach out to your HR team or your benefits team and ask if they allow post-tax contributions. That's the official word for it. The personal finance community calls it the mega backdoor. That's like the jargon for it, but these are post-tax contributions. So if you have access to this, you can defer up to $57,000 each year from your income into this amazing vehicle for tax savings for retirement. So we love a mega backdoor. If you're at Amazon or Asana, we're probably already doing it for you. And I'm going to hand it over to Emily to talk side hustles.
Yes, side hustles and your 1040. So if you have a side hustle, or even if all of your income is coming from your small business, it's important to know that if you're a sole proprietor, you're not paying yourself through a W-2. And since you're not paying yourself through a W-2, you're not withholding anything for taxes throughout the year. And since you're not withholding, it's important to be conscious that come April 15th, you're going to not have paid in anything to the IRS to help offset what you owe on tax day, unless you've made estimated tax payments. And you make these estimates quarterly. I've listed the due dates here. So now is a great time to start thinking about whether or not you've made estimated payments for 2020, or whether you're going to need to start setting aside additional money for your tax bill in April. As a reminder, the fourth and final payment is due January 15th of 2021, and that will lower your 2020 liability. And you can make this payment even if you didn't make first, second, or third quarter estimates. And I've added a visual here down on the right just to kind of show the difference between a W-2 employee who is withholding and a sole proprietor who can't withhold and who also has not paid in anything for estimated taxes. You can see that the total tax is the same between the two of them, but come April 15th, one has a substantially larger amount due. And the thing to really know here is that the IRS expects to receive taxes from you as you're making your income. So throughout the year, they want their money. They don't want all of that on April 15th. So when you withhold, you're paying the IRS. When you make quarterly estimated tax payments, you're paying the IRS. If you're waiting until April 15th to do it, they're going to penalize you. So that's something to be conscious about. I think that's all I have for this slide. AJ, if you wanna, am I able to flip next? There we go. Okay, so kind of staying on the topic of sole proprietors, now is also a great time to get organized and look at your 2020 expenses. Don't wait to do this until April 15th because, or April or March even for that matter, because your sole proprietor expenses are going to directly lower your tax liability. And a lot of times with clients, they wait to look at this until last minute and are overwhelmed going through like credit card statements and bank statements and don't capture all of the expenses that they could have. So they're losing money. I've listed some common Schedule C expenses here. And then I've also linked our tax organizer, which can help you organize those expenses. Another great thing to think about if you're not organized would be getting a bookkeeper. And I'm going to talk more about the home office deduction on the next slide. And that's because we're getting a lot of questions about home offices because of COVID. Everybody's working from home right now. And probably the most common question that we get is just, can I deduct my home office? And the answer to that is, if you are a W-2 employee, no, you can't deduct your home office. If you're a sole proprietor, you can. We actually just did a webinar about a month ago, which is uploaded to this link, where we talked in more detail about the home office deduction. But if you are eligible to take the home office deduction, this is what we're going to look for you to provide to us so we can do that calculation. And this little like screenshot that you're seeing here, that's all within the Schedule C organizer, which was linked on the previous slide. So feel free to access that and take a look.
Just so you guys, just sorry to interrupt, Emily. So this webinar will be recorded, and I will drop links to all of these references in the chat for you guys to grab in just a moment.
Okay, great, thanks, AJ. So basically how it works is that you give us the measurements of your home office, like literally take out a tape measure as it says here, and then give us a square footage of your home. And we'll get a ratio from that, and we'll apply it to your annual rent or your annual mortgage. So you can deduct your home office if you're a renter or if you own a home. We can also apply some of that and take a deduction for your utilities that would be going towards the home office. Something to think about is that if you're working from your kitchen table, that's not considered a home office. It needs to be used exclusively for business. It doesn't matter how large or small the home office is, just exclusively for business. Excuse me, how large I want to say is like in, you don't want an absurdly large home office that could raise some red flags. But that said, another thing to consider is like, we get questions, I own a gym and I do my admin from my home. Can I deduct my home office even though like my business is a gym? I'm a sole proprietor. Yes, you can still deduct your home office if you're conducting business administration there. So that's another thing to think about. And on the next slide here, I just don't get overwhelmed by this slide. What I really wanted to show is how your business expenses lower your tax liability. So you can see you have your business income, you deduct all of your business expenses from that, and you get a tentative profit and loss. And then you get an additional deduction if you have a home office. And then that $36.58 that you're seeing here is your business income, which is going to go directly to page 1 of your 1040 personal income tax return. And that's what you're going to pay tax on. So the more expenses you have, and obviously like actual business expenses, the more expenses you capture, the lower this is going to be and the lower your tax liability is going to be. So get organized now to make sure you're capturing all of those expenses. I'm kind of switching, staying kind of on, I'm ready to go on to the next slide, not yours quite yet. Still talking about sole proprietors, but also just self-employed individuals. A great thing to be thinking about right now is a SEP contribution. And why this is good and potentially more beneficial than, a 401k or a Roth or traditional IRA is that you can contribute much more to this retirement account, up to potentially $57,000. You have a limit based on certain factors, but you can contribute a much larger amount, and then you get a deduction dollar for dollar in the tax year that you make that SEP IRA contribution. And it kind of follows, rather than a calendar year, it follows the tax year. So if you've extended your personal tax return for 2019, meaning you're going to file it October 15th, you can still contribute to a SEP IRA and deduct that amount on your tax return for 2019. So it's something that you can still do if you haven't done so already, if your return has been extended. AJ, do you want to?
I wanted to add something, but also I wanted to point out that we just got a reenactment of that famous meme of the baby interrupting the guy commentating on, I forget what it was, because Shane's dog Charlie just opened his door, and that was hilarious. Charlie is the Australian Shepherd, aka son of Shane. I did want to add that the reason we love a SEP IRA so much is that ability to extend the deadline. So, when people talk about going on extension, it's never an extension to pay any tax due. It's just an extension to file your return. So a lot of people get that wrong. If you say I need an extension, I need more time to figure out, what I owe, you still owe the tax starting on April 15th. what's so cool about the SEP is that when we extend the return to October, we get an extra 6 months. We actually get an extra 6 months to contribute to that SEP. So maybe on April 10th, you don't have the $10,000 you want to contribute to your SEP for the last year, but you're going to be able to save that from the cash flow of your business until October 15th. So you might be kind of like a year behind with retirement contributions, but it's just a great way to maximize that tax deduction. And right now, given that it's, September 24th, if you're on extension and you're a freelancer or a sole proprietor, now would be a great time to consider a SEP IRA. We've still got, 20 days to open them. They're not as hard as a 401k to get started. That's why we love them.
Yeah, so this is a great thing to think about for this tax year yet, and for next tax year as well, if you don't have one set up. Okay, so now I think we're going to switch gears and talk about charitable contributions. What we really wanted to emphasize on this slide is that it pays to be smart about your generosity. So typically, with the exception of this year because of the CARES Act, and I'll go into that more on the next slide, typically if you take the standard deduction, you don't get any additional deduction for charitable contributions that you've made. And most of our clients take the standard deduction unless they own a home, because if you own a home, you're paying property taxes, mortgage interest, and that tends to push you above the standard deduction amount. And when you're above that standard deduction amount, it's called itemizing. So then you're able to itemize, and when you itemize, you get a dollar for dollar deduction for charitable contributions for the most part. That said, since a lot of our clients are pushed into that itemized deduction when they purchase a home, if you're thinking about purchasing a home in 2021, and it's September right now, so we only have a few more months left of 2020. If you are planning to make a large charitable contribution in the next couple of months, but you're taking the standard deduction right now, it might make sense to hold off and make that contribution January 1st of 2021, because you're going to reap a far greater benefit from a tax perspective if you're itemizing. Another thing to think about is if you're contributing to charities like $5,000 every year, but you take the standard deduction, maybe you hold off and every couple years you make a very large charitable contribution, so that pushes you over the standard deduction and you itemize and you get to deduct that charitable contribution on your tax return. So just a few things to think about there. If you do want to deduct your charitable contributions, you want to make sure you're donating to a 501c3 organization. I've linked right here where you can see if a charity is a 501c3 or not. It's at the IRS's website. And then, this is very important right now. We all know political contributions, it's a big year for that, but you cannot deduct political contributions. A lot of times we get clients sending us the political contributions that they've made. You can't deduct them. Don't make a political contribution because you want to deduct it on your tax return, because you won't be able to. Moving forward, to kind of contradict a little bit of what I just said, with the CARES Act, that allowed for an additional up to $300 of deduction on top of the standard deduction if you've made donations to a 501c3 charity in tax year 2020. So if we hop back a slide and we look at the standard deduction being $12,400, it's really going to be $12,700 potentially if you're contributing to a charity, and it's on a per person basis. So if you're married filing jointly, you can take the standard deduction and potentially an additional $600 for charitable contributions that you've made, which is great. And then another cool thing that we wanted to point out that changed with the CARES Act was early retirement cash out. And I'm just going to add a little exclusion here. This is something that you should talk to your financial advisor about before you pull out of your retirement savings. But basically with—
I don't like this slide. Sorry, I didn't mean to interrupt. I wanted that caveat. We don't recommend this, but it is available.
I don't want to get you like too excited that you can just withdraw out of your retirement savings, because it's not something that you really want to do. If you need to do it because you've been adversely affected by COVID, you're able to pull out up to $100,000 without getting penalized. And typically, if you pull out of your retirement savings, your 401k, your IRA, before 59 and a half, you're going to get hit with a 10% penalty on what you pulled out. So with the CARES Act, you can now, if you've been adversely affected by COVID, withdraw up to $100,000. You still have to pay tax on this. You can spread it out evenly over tax years 2020 through 2022, and pay tax on it like one third roughly. And if you actually pay that money back into your retirement, then you'll get a refund for what you were taxed on. And just a little exclusion here, if you do need to pull out and you're going to be paying at a much lower tax bracket this year. Let's say you were very affected by COVID. You're paying much lower tax percentage this year. It might make sense to recognize all of that $100,000 on your tax return this year, because it's taxed at a lower bracket, and then you can pay it back into your retirement savings over the next 3 years. So that's kind of the smartest way to potentially do this, if it's smart at that.
But also the most complicated.
Yeah, fancy and complicated.
Yeah, talk to your advisor.
Cool. Well, all right. College savings. Shane Mason, take us home.
Yeah, so we just have two or three more slides left.
Yep.
To cover some year-end stuff, college savings, tax loss harvesting, and some business stuff. For those of you that own businesses, including sole proprietorships, S corps, partnerships, etc. This is designed for those of you with children or anyone else that you would like to help make it through college. There are special accounts called 529 accounts, named after a code section within the Internal Revenue Code. Anytime that there is a tax thing with a number in front of it, that's because it's a code section, typically, within the Internal Revenue.
Very creative over there at the IRS.
Yeah. So what these accounts is they're kind of like 401ks, wherein the goal for the distributions from them are not to pay for your retirement, but they're to pay for kids' education. Okay, so, and this can be, the beneficiary can be anyone. It can be, you can name yourself, you can name a kid that you know, you can name a future kid. If you're thinking about having kids, you have an unborn child, you can still found a 529 plan and get a tax deduction for funding it. Okay, so some of the caveats there are that the max you can get as a tax deduction is $5,000 per spouse, so up to $10,000. It's not per child. It's per spouse. So, and this is also a deduction purely at the state level as well. It's not at the federal level. Okay, so if you're in a high tax jurisdiction like New York, which generally has a New York City, I should say, which generally has a 10% tax rate. If you contribute $5,000 into it, it's saving you $500 in New York taxes, which is cool. That's a nice tax savings. The bigger benefit to this, for those of you that understand compound interest, is that the growth of the account will not be subject to income taxes. So just like your 401k, which gets to multiply, and there's no taxes on that, so Uncle Sam doesn't have any interest in the returns, so your snowball gets bigger faster. Those of you that are Brooklyn FI clients might reference the bunnies analogy, where the bunnies get to multiply so much faster because they're not subject to income taxes. It gets to grow a lot to a much larger amount over the 18 to 20 years, 24 years for those of us to take a little bit, take some victory laps in college, that we will be using these funds in college. So some people may be worried that whoever they name as the beneficiary may not go to college. Maybe Google is just going to get rid of higher education in 18 years. They're certainly trying to right now. So what happens if the money is not, there's no beneficiary? Well, you can change the beneficiaries at will. You can go back to school and go to grad school. You could change the beneficiary to grandkids, anyone. You can change it to anyone. So there's flexibility there. Worst case scenario is that you have to withdraw the account, or withdraw the money for non-education related expenses. And to kind of help you navigate, well, can I overfund to 529? I do want to pay for my kids' education, but I don't want to put too much money in here, because if I put, $10,000 in every year for 18 years, it's $180,000. Like, surely that's too much money. Well, the cool thing about that is because it's tax advantage, when we run the numbers on that, your alternative option here is to fund just a regular brokerage account that would be invested and would be subject to taxes. Because the blue line here on this chart shows a 529 growth from 1989 to 2017, and then having all of that money withdrawn and paying the 10% penalty on it, you still come out ahead of a regular taxable account. So you don't really have to worry. Like, even if you pay a huge penalty on the distribution, you'd still come out with more money than you would use within the regular taxable brokerage account. So there's not, that argument doesn't really stand up, being worried about overfunding it and paying a penalty on the distribution. So feel free to go ahead and fund those things. Hashtag they did the math. Anything else here, AJ, that I should touch on? Oh, you can't, for New York, for example, so with the Tax Cuts and Jobs Act, they expanded the options for use of 529 funds, which is great, because education just keeps getting more and more expensive compared to other inflationary products. So they allowed for 529 funds to be used for K through 12 if the states allowed and opted in to that program. New York specifically did not opt into that. So you cannot use the funds for K through 12. So those of you trying to get a kid into a Waldorf school and use 529 plans for that, unfortunately, you'll have to save them for college or for another state, should you have moved due to COVID. Cool. AJ, you gonna move us forward? I think we might have a frozen screen. There we go. Are
we back?
Yeah, we're back.
We're back? Cool. Cool. I heard trying to get into a Waldorf school, and then we lost you.
That's it. We just need the next slide.
Okay, cool.
Cool. So that's 529 plans and how they can assist you with saving for college in a tax advantaged way. Tax loss harvesting is something that is available to more people than college funding. Those of you that don't have kids or plan on funding someone else's education, even if you do have kids or nieces and nephews. Tax loss harvesting is a concept surrounding capital assets. Okay, so stocks essentially, or Bitcoin are the main, or crypto in general, are the main things that are going to qualify for this strategy. So if you have capital assets such as stocks, bonds, crypto, homes, we're not going to talk about homes right here. So mostly stocks. So you can take losses on the sale of stocks, and it'll actually help with your tax bill. Okay, so if you bought something for $10,000 and you sold it for $5,000, you have a loss of $5,000, right? If that's a drum kit or something like that, that's not really going to qualify for this. But if it is a stock at a brokerage such as maybe Snap, maybe any ETF, which is a basket of stocks, if you hold the EMTY ETF, EMPTY, which is betting on the decline of the retail sector, and it has experienced some volatility, such as the market in general in the bottom left here. So you can see back in March when COVID happened, the market took a big dip. That would be a great opportunity for you to look at your investments and say, all right, which one of these has experienced losses, sell that and potentially buy something materially similar. And then you have what's called a tax loss harvest. Okay, and then when you go to file your taxes, you will still have, you're still invested, right? Like if you just sold that thing and bought something else, you're still invested, but on paper, you now have a loss that you can take against your taxes. If you were just gonna let that ride back up to where we are now, where you're actually experiencing gains, you missed an opportunity to harvest losses earlier in the year. It could happen again. You might be holding stocks that are currently available for tax losses. By the way, this is only for assets that you hold in taxable brokerage accounts. So your 401k, your Roth and traditional IRAs, the losses that you would experience in there, just like the gains, are never subject to taxable consequences. That's the whole value of them, because as you have gains, dividends, interest, etc., you never have to pay Uncle Sam. Whereas in your taxable brokerage accounts, for those of you that have the wealth sufficient to fund those, you have the opportunity to harvest these losses. And we have we have an example in the bottom right here of how beneficial that could be to somebody that has, just to keep the math simple, we have 50,000 of income and the person paying a 33% tax rate. If they don't harvest any losses, they would have taxes of 16,500. We're ignoring withholding or estimates and all that stuff. Whereas if they were able to recognize a loss of 3,000, their income would go down by 3,000, and they would only have taxable income of 47,000, which would reduce their tax bill by $990. So $1,000 just by being smart in March here would have saved you $1,000 if this was your tax rate. One caveat here is that the maximum in losses you can take in a given year is 3,000 in a tax year, not a given year. In a tax year is $3,000. So if you had a $5,000 loss, you can take 3,000 of that, and then the remainder is carried forward, which I think is different from my example, but I think you guys get it.
Close enough. Cool.
Yeah. Cool. Next slide, please. Cool. So some other tips for business owners, some things that we'll be discussing in our other webinar. I just threw these in here real quick because there are some really quick, like actually implementing any of these things is a lot heavier lift than just listing them on a slide. We're going to talk about these in more detail in a month. Some tips for business owners. If you have a business that allows you to run payroll, which is partnerships and S corporations and C corps, sole props can do it too, actually. So all of you that have kids, you can get them active in the business, and you can shift income from a high bracket, your bracket, to your kids' bracket. How do you, they actually have to do some work. What kind of work qualifies? Modeling, sweeping, services, janitorial stuff. You want to document that. We talk about that in our business webinar. You can set up, for those of you that don't have employees, you can set up solo 401ks. For those of you with employees, you have to have a traditional or a safe harbor 401k. For those of you that are hiring employees that formerly had a solo 401k, you need to transition that 401k. And for one of our webinar participants that now knows that if you hire employees, then you need to be wary of how you need to update your benefits and your 401k disclosures and availability to your employees. You can form it, for those of you that are sole props outside of New York City, we're going to want to form an S corporation to minimize payroll taxes. For those of you in New York City, it's more complicated than that because you have to worry about the city tax on your income. Other tips for business owners is managing your payroll in general to maximize your 401k, qualified business income, SEP IRA, and all of those things, because that is a choice that you can make on your reasonable compensation. Fine tuning those to make sure that you hit the right numbers. There is a science and an art to figuring out the exact right amount of payroll to pay. We have a service called Outsourced Accounting, aka Outsourced CFO, wherein we do that math for all of our clients. And that's all I've got, AJ. There's
Cool.
a lot more. There's a lot more than that, but this is not targeted for that.
Yeah, and just so you guys know, that webinar is happening, I think I said Friday earlier. It's Thursday, October 22nd at 5 p.m. Eastern. We'll cover a bunch of the things Jane just mentioned and more. We also have another webinar coming up on October 6th. I don't know what day, I think it's a Tuesday, might be a Thursday. We're gonna unpack open enrollment. So a lot of you who work for companies have an opportunity to elect your health insurance, your life insurance, disability insurance, pet insurance, pay for lawyers, all of the benefits that your employer offers to you. You usually have one opportunity each year to make changes to those benefits. That's called open enrollment. It usually happens in November for 95% of companies. We've got a webinar to walk you through picking the best benefits. This is something we do with all of our clients. We've got a ton of resources. So if you are curious about which health insurance plan to pick up, what's an HMO, what's a PPO, what do these fucking letters mean anyway, that's the webinar for you. We've got just a few more minutes, and Shane, I've got a few questions. Someone had a question about tax loss harvesting, and the question was, do carryover losses expire after a certain number of years? What if they are never utilized?
So they don't expire. After the Great Recession, there was a 90-year-old lady I did her taxes for. She had like $1 million literally of capital loss carryovers. So her opportunity to harvest those was limited. as limited as their lifespan. The recommendation there is to get married to a younger person, an arranged marriage, to make sure that those carryovers exist. That's not advice.
Brooklyn FI in a few years will just become mostly a matchmaking service, just so everybody is aware. Another question that came in through our registration, should you only contribute the employer match amount for 401k if you have already maxed out your IRA? No, I would, if you have free cash flow, the next best place to save $1 is going to be into your 401k. So if you're already getting the employer match and the 401k and you're contributing to that IRA, if you still have some money left over, yes, let's go back to the 401k and contribute even more. The employer match is very valuable. I don't want you to be discouraged if your employer does not offer a match. An employer match is a great perk, but it is just that, it is a perk. So you might read some articles by some old farts who are gonna say 401ks no longer make sense. Ignore them. 401ks are an incredibly valuable savings tool, even if there isn't an employer match.
What's our order of operations, AJ? Fill up the emergency fund, fill up the 401k, fill up the IRA, fill up the HSA, then you move into taxable accounts. And there's
Exactly.
29s in there somewhere.
Exactly. So, you know, a lot of folks ask us like, okay, well, I want to invest in the stock market, right? I want to start tomorrow. I opened a Betterment account, or I opened a Robinhood account, I'm investing. And as our clients know, you know, Shane and John and I and Emily are going to say, I don't want that dollar going into the Robinhood account. I want that dollar going into your boring old 401k. A 401k is investing. Remember, it's for retirement, it's for your future self, but it is very much participating in the stock market. So when we go through the order of operations, you have $19,500 to go in that 401k. You have $6,000 to go in the IRA. So unless you're an incredibly high income earner and you're able to save more than $25,000 each year, you probably shouldn't have that Robinhood or extra Betterment or Wealthfront account, because all of those dollars should be going into those tax advantaged accounts, which we covered earlier today. That's my soapbox that I will always get up on and yell. If you see me at a bar and get me drunk, I will continue that rant for many, many, many more minutes, as Shane has heard me do many times.
That's where the braces all through high school comes from.
Now I feel sad. Okay, last call for questions in the Q&A, or you can drop them in the chat. We'll wait around for one more minute. Emily, any final thoughts or anything to add as we head into our year-end tax planning meetings?
Just get organized. We see it every year, people throwing in stuff last minute. We're always working up to the deadline. The deadline never changes. Just, you know, look at what you have right now, slow and steady, instead of like doing it all as a crunch in the end, because as I mentioned with like the business expenses, you're likely going to capture more if you take your time going through them in an organized manner rather than like last minute. And it helps us too. We appreciate all being organized and timely. So that's my soapbox.
Awesome. Shane, any final thoughts?
We have another question I'd like to address.
Oh, sure.
What type of tax consequences come from working remotely in a different state than your employer? That is a complicated question. It depends on the state. Every state is different. We actually recorded, Emily and I did an hour-long webinar on the complications surrounding that I will send to this question.
I'm dropping it in right now.
Okay, cool. It depends on, there is convenience rules wherein the state, yeah, it's a long answer. We will post the residency webinar that we recorded. We'll send it over to you and post it in the show notes?
In the chat.
Yeah.
Sure. It's going in the chat. Yeah, it's brooklynfitax.com/events, which is dropped in here a few times, but there's a direct link to the YouTube. It's an hour long, lots of details in that will definitely answer that question.
Yeah, the main takeaway is that if you're trying to establish residency in a new state, you need to break up with your old state, aka move out, and then start to date your new state, wherever that is, by moving in and trying to break residency with your old ex. And then you want to update HR on where you're a tax resident by filling out a new, by updating your tax residency, and they'll start withholding in your new state and stop withholding in your old state, so that when it comes tax time, the reconciliations between the taxes due and the taxes you paid are not grossly incongruent. Sorry, that was the last thing I wanted to add. Anything else to add? The 12/31 December is going to be here before we know it, and then the opportunities to execute on these year-end planning strategies are going to be gone. So start looking at your brokerage accounts right now. Start thinking about making those contributions. It's a lot easier to retirement accounts. In all things financial, it is a lot easier to break things down into singular steps or small pieces and to digest them week by week than doing them all at once, such as 401k contributions, solo IRA contributions. Instead of doing a lump sum $6,000 in December, it's a lot easier to do $1,000 per month up until April. So please get started. The earlier, the better. It also gives your money more time to compound within those accounts, which means that there's just going to be a lot more there at the end of the rainbow. That's it.
Cool. Thanks so much for joining us. We'll try to post this by, not the end of this week, that's tomorrow, early next week on our website. And we've got some other awesome webinars coming out this fall. A lot of crazy tax changes this year. We expect a lot of crazy tax changes next year. So if you're worried about by the end of the year, if you're not a client already, or if you're just looking for some advice, it doesn't have to be us, but reach out to an accountant or financial planner with plenty of time, right? If you reach out to someone on December 1st, it's probably too late to get advice before the end of the year. Now is a really great time to start those conversations. Make sure you can actually implement the tax saving strategies we talked about today. Thanks so much for coming, everyone. We will see you in a few weeks.